Let's talk to Patrick Reid. It says that he is the co-founder of Adamis Principle. Hopefully I got all those pronunciations correct. Morning to you, Patrick.
Thank you.
Right, you've got 3 thought-provoking slides you've sent over. Let's kick off without further ado. The Euro-US dollar contract, the daily charts. We've had a number of people coming on this week suggesting that on the technical, certainly, it looks quite weak.
Well, I disagree. I've got 4 main reasons why I'm bearish dollar. So let's just look at the chart. Basically, on the daily, we are still bullish. We're consolidating at the highs. We have failed to break the 38%. We're above the 2 key moving averages, the 100-day and the 200-day. But there's a whole host of reasons why I'm broadly dollar bearish. And the reasons are this. Dollar can't go up on good news. CPI, non-farm payroll, blistering headline, weak wages, admittedly, can't really lift. Nothing really can help our good old friend Benjamin. The other one is dollar index and 10-year divergence, still in play. Now that outrightly, initially, is not a key reason to sell the dollar, but it's not good. On a side note, 10-year yields look quite toppy. So, you know, we're still flirting around 2.8%. If this doesn't progress to break 3%, I think we could retest 2.6. If that is the case, that will trigger a short squeeze. And let's not forget on point 2 that if we do get a short squeeze, it's going to be very, very bearish on the dollar. The other main thing was the Fed on Wednesday. So, you know, it was all about, there's a big talk about the dot plot. Everyone's saying, oh, look at the changes in the dot plot. 2008, it was the same. 2009, it was 0.2 higher. Normally, this would lift the dollar. The dollar wasn't bothered. Actually, the dollar sold off. You know, Jay Powell, very direct, very clever man, very, very different to predecessors. However, despite the uplift on the votes, on the median path of rate hikes, dollar could not take advantage of this.
Okay, so that really is contrarian to the thoughts of a number of pundits who have come to see us in the studio this week.
Well, that's, you know, I came in a few weeks ago, and one of the questions you asked me, Nick, was what was my trade? I say buy 10-year bonds on the US, to buy the T-note, because of this imminent short squeeze we're having. And that view just doesn't change. If you look at the dollar index,
yeah, this
is very, very key. We're staying below 91.
Okay.
We're failing that. That is a key level. You know, if we do get a bond squeeze, this could test the lows at around 88.50. That's my view. And, you know, it's the sum of the parts. Dollar, you know, yields are looking very toppy, very, very tired. And, you know, let's not forget we are net short as well. So all of this could squeeze, putting more downward pressure on the dollar.
Okay, so dollar weakness, euro strength. Let's wrap up with your third chart. LIBOR, room to run, question mark. I like question marks.
Yeah, absolutely. So Morgan Stanley is saying this is the story of the year. I agree. And the reason is, just in case, just to sort of fill you in, LIBOR OIS is the London interbank offered rate spread, or the difference between the overnight index swap. So what does that actually mean? Essentially, it's, if you're on an oil rig, it's the amount of danger money you pay. It's the, you know, when it goes up, the risk is elevated.
Okay.
So the main 2 narratives that the growing or the continuing chorus has is short-term paper issuance for Q1 via the Trump largesse in the fiscal relaxation. This is the main narrative. However, my point is this: if it looks like a canary and it tweets like a canary, maybe it is a canary in a coal mine.
Okay.
This is not good. This is absolutely not good. If you look at the around the 2006, this is the China credit crisis. So, you know, if you just go back, every time this spikes, and this is just really not good. This is basically, LIBOR is the credit stress. It's the amount of risk that increases from zero risk, which is basically the Fed.
So this is spiking, and this is a risk, a risk sort of scenario. So how far could this spike?
Well, 50 basis points was a key point that many of the top banks were saying. If it hits this, a thing called swap lines will kick in. Basically, it's a key level because when it spikes, there's less liquidity, so there's less appetite for banks to lend to each other in the money markets, i.e. short-term paper, repo markets, stuff like this, treasury bill market. So everyone's thinking, well, when 50 basis points kicks in, it's all going to kind of abate. Obviously, it hasn't happened. This could run a lot longer.
Right.
The key date for me, Nick, is Q2 because that's when the issuance stops. So if the chorus is correct, and everyone's citing the short-term paper flux, the influx, if that continues in Q2, i.e., a week or so, then there's big trouble ahead.
On that note, Patrick, we'll see you in 2 weeks' time. There may be trouble ahead. That rings a bell somehow. Patrick, as always, thank you.